Welcome everybody back to Markets Mindset here at Mizuho. And usually, guys, we do this market mindset and discuss what went on for the previous quarter. But obviously, with what happened on April 2nd, I'm not sure the quarter means as much now as it did maybe a short while ago. So we're going to try to take things as they are now. Year to date, supply is running maybe 2 percentage points behind where it was last year. So we're pretty flat there. 10-year Treasury is probably at its average yield. At least today's at its average yield where it's been year to date. And the index is sitting around 107. Keep in mind highs of 172 during SVB, 275 during COVID. I think our tight we got into was 77, 78. So Moshe, describing where the macro is at this moment, how do we translate that into recommendations for an issuer? Specifically, if you're an issuer who has a short-term horizon, looking to raise money in the shorter term, but also then people looking out further, people who maybe don't need the money until, call it late third, early fourth quarter.
Yeah, two different answers there, Victor. So if someone is looking for capital in the short term, and let's define the short term, 3 to 6 months. I mean, if you're a corporate, that means you have limited windows within that 3 to 6 months because of earnings blackouts, et cetera. So given what we're seeing in terms of overall macro volatility, but at the same time, looking at the current strength of credit, I would advocate looking at those windows when they present themselves. Because right now you have a little bit of a dichotomy between what credit is telling you and what you're hearing in the equity market. Equity market is a little bit more doom and gloom that we're seeing in credit. In credit, we have seen real money start to buy at the wides. And we have seen new issues, to your point, work well and trade well. All right. But there is a point where maybe the equity story starts moving into credit rather than the other way around. And what is a window right now may not be one in the future. Because as Colby's going to tell you, what we're seeing in the market right now is one of a recalibration of risk premium, not a closing of the liquidity window. Longer term, I just wait. I'd wait to what we're going to see over the next 2 to 3 to 6 months potentially, because what we're dealing with right now is arguably not sustainable for the long term, just given the amount of volatility it creates. So there's going to have to be some leveling off, and we just don't know exactly where that's going to be for the better or for the worse. So I think time you should view as an asset rather than a liability, and take full advantage of it so the crystal ball becomes that much clearer for you.
So Colby, that's just appropriate to turn it to you now. So
all right.
One of the bright spots in this market has been that when we've opened up strong in the morning or with a positive tone and new issues have showed up, the bid has been there. Liquidity's been strong, and it's remained pretty strong, both front end and out the curve. Discuss a little bit of that and what we're seeing and why.
No, absolutely. As Moshe said, it never was a liquidity issue when it comes to the investment grade market, particularly the new issue market. Sure, we had 2 weeks of lower than anticipated or lower than kind of average supply. If you look back to the 2 weeks prior to last, where you had 5 billion and just under 10 billion of supply. But to Moshe's point, that was more about the issuers not being willing to pay the new issue concessions or the spreads that would have been required to bring a new issue. The demand was there. How do each day in aggregate over the last add by investors of 8 billion of paper. So dealers have been able to de-risk by 8 billion, and accounts have added 8 billion of risk. And that's despite, seeing some pretty sizable outflows. So liquidity is definitively there. It's more about issuers being willing to access it. The other thing that we've looked at is certainly the other asset classes that are out there. The commercial paper market, even during the worst days, whether it was the rate moves, whether it was the equity moves, remained open, remained functioning, and remained very orderly. Sure, we've seen some adjustments as relates to tenor in the CP market. Absolutely. But it's been open, and we've seen some readjustments from price. Even this week, we've started to see the ABS market come back alive. For a period, we really hadn't seen any issuers come to the ABS market. There were deals that had announced or done 15 Gs, excuse me, and then did not follow up with the transaction. Those deals are starting to come now. And we're on 2 of them this week right now, and both of them are going very well at this stage in the game. So we're seeing cash, we're seeing the investors want to add. It's more about just finding the right price to Moshe's point. Last thing I'll say is that you look at the movement that we've seen in risk, or the movement we've seen in spreads. Obviously, it was a very quick move wider post the announcement on the second. We went from about, call it low 90s, depending on which index you look at, to roughly right around 120 basis points or so at the highs. That took only about 4 or 5 days. Since then, we've kind of steadily moved tighter. We're sitting probably about 10 basis points inside of those highs over the last couple of days here.
Where are you versus other markets? I mean, we've talked about the dollar market here, but we have a difference here where the ECB has eased on a relative basis, an enormous number of times compared to the U.S. What are you telling your clients about opportunities in, say, euros relative to the dollar?
Victor, I've been having a lot of conversations with people about euros for 2 reasons. First off, the differential versus the U.S. has been expanding and pretty materially over the last week or so. And given the strength in the euro, the ECB is in a position of a lot more latitude versus the Fed. And I think that's going to continue to get reflected in the rate market. So that's one. I think, 2, you're going to be seeing a fair amount of fiscal spend in Europe, which, again, I think is going to be a credit positive for people. So there's going to be, I think, tailwinds in Europe that aren't exactly going to be here in the United States right now. And if that gets amplified by a growing funding difference or growing basis between mid swaps and treasuries, then that's going to be very attractive to people.
One thing I wanted to follow up and ask you before, always a tough one to ask you where spreads are going. But in particular, as the treasury curve has steepened, right? We've seen 10s, 30s have steepened, 5s, 10s have steepened quite a bit. Even 3s, 5s are at 17, 18 basis points. Very different than what we've seen, going back a year.
Mm-hmm.
What do you expect to happen with spreads overall? What do you expect to happen with spreads on a relative basis, 3s, 5s, 10s, 30s?
I mean, that's a great question. I think there's a lot of other factors that are going to drive where those spreads are going to be outside of just the treasury shape, right? I think if you think about traditionally what you would expect to happen as the treasury curve steepens, you'll see a flattening of that credit curve. I think we've already started to see that, particularly in the front end. 3s, 5s is probably flattened anywhere from 5 to as much as 10 basis points on a spread standpoint, depending on the name and depending on the sector. And I think we could see kind of that kind of theme develop thematically kind of between 3s, 5s and 5s, 10s. So one of the interesting things I think that we've seen, and we can look at T-flow to use this, so look at secondary volume to kind of drive this, is that if you look at the $8 billion of net buys by investors that we've seen since April 2nd, over half of that has been from out the curve, so 12 years or longer, which I think is certainly a driver of that kind of flattening of a credit curve as investors are looking to add duration, and we're hitting the yield bogeys, particularly with the move higher in treasuries, combined with the move higher in spreads. The front end of the curve, we certainly saw some what I would call disorderly behavior immediately following the announcement as investors were getting ahead of or getting prepared for outflows. We've started to see some more positive behavior from investors in the front end of the curve and a more return to normalcy there.
I went through the numbers. We're pretty close, maybe off 2% total supply versus last year, a little bit more, maybe 13% on net supply we're running behind. As we roll out of blackouts, right, we went from supply numbers that were averaging 50 billion a week for the 4 weeks prior to April 2nd. And we have, other than last week, if you take the average over the last 2 weeks, it's pretty light. What do you think happens supply-wise going forward? Do you think there's enough issuers who are worried about where we're going to be 6 months from now, that they're going to come out of blackout and look to hit the market? Or do you think it's really going to depend on the opportunistic kind of view of the world and whether they hit a bogey they might be thinking about?
I think it's going to be somewhere in the middle. This isn't going to be COVID all over where everyone's out there with a liquidity grab. At least that's what it feels like right now. That being said, I could see someone who has bonds maturing in 2026 and Powell's term is up in May of 26, and they want to hit the fast forward button on that because they want to have to deal with the noise of that. I could see that, but I don't see, like when we saw COVID, we hit all-time volume levels. We're just not going to see that based on
people
that.
don't think in COVID, they thought their cash flow was going away, that their business model wasn't going to work.
Exactly. And so you also have clients who looked at their free cash flow and had M&A budgeted for that. Well, that M&A is in the hibernation closet for the time being. All right. So that's additional cash flow they can tap. So we are by no means, at least in my opinion, going to overwhelm this market with supply.
So we'll finish with, what are we looking at going forward? I'll give you both an opportunity. Moshe, you first. Colby, you second.
Absolutely.
What are the 2 or 3 key barometers you're going to be looking at?
I'm very macro right now, Victor, as you know. So the 2 things that stand out to me are the dollar and the shape of the curve. So if we see 2s, 10s, which is already steep into 60 basis points, if we see that momentum continue and the dollar becoming that much more vulnerable at the same time, then it's really hard to construct a rosy picture for risk assets.
And Colby?
I'll be a bit more specific, I'd say, to investment grade. I think it's going to be about flows, right? I mean that both from looking at the secondary side. As I mentioned, we've been very fortunate to see accounts adding risk during this period, right? Real money stepping in and buying at the Ys. And so we have not seen dealer balance sheets be put in much pressure. It's been more about a lack of selling by investors. If they start selling, we start seeing the outflows, forced outflows, either because they're losing money or just because they start feeling less comfortable with their risk. That's when I start to get more concerned about, the liquidity picture as it relates to the primary market in investment grade.
So that takes the place of, I remember back in COVID, difficult market, and then the issuers were the sellers just dumping a lot of supply in the market, and that really put us under pressure. So you're looking, maybe not the magnitude, but you're going to be watching secondary spreads and secondary sales.
Exactly.
I say net sales for
exactly. The movement that we've seen from a spreads perspective has been, we move wider, we find kind of some stability. We move wider again, we find some sense of stability. It does not feel like it's been the same dramatic or quick movements that we saw during COVID, where it felt like you were kept trying to catch a falling knife. Right now, it's been about a readjustment of spreads, readjustment of price, and not necessarily a de-risking or a selling down of positions from accounts.
Well, listen, I thank both of you for being here. As always, Moshe, Colby, appreciate you coming on. Probably have you back. Hopefully next time we bring you back, it'll be a little bit calmer, a little bit more stable, and we'll be able to talk more about what went on in the quarter. But until that time, thank you very much for joining us.
Thank you.